And welcome to this special coverage. I'm Ashmit Kumar, and let's start with the headlines we're tracking this evening. Finance Minister looks to push growth while staying fiscally prudent. The government expects the union budget to drive consumption and also give a fillip to bank savings. Government tweaks slabs under the new income tax regime, effectively makes income of up to 12 lakh rupees a year tax-free. But people earning over 24 lakh rupees will pay tax at 30%. FM says the changes will see the government losing 1 lakh crore rupees in direct tax revenue this year. Government aims to achieve 91% of its capital expenditure target this year, hikes the capex outlay for next year by about 10,000 crores to a little above 11.2 lakh crore rupees, which it is confident of meeting. Government stays firm on the path of fiscal consolidation, targets a fiscal deficit of 4.8% this financial year and aims to reduce this to 4.4% in the next fiscal. US tariffs on Mexico, Canada and China come into effect in response. Both Canada and Mexico say that they were preparing similar tariffs on US goods, while China added that it will take necessary countermeasures to defend its legitimate rights and interests. Well, the union budget looks to drive consumption by putting more money in the hands of the middle class. The budget also saw only a minor increase in government capex as it called on states and the private sector to do their bit. The government also stuck to the fiscal glide path. In a relief for taxpayers, income of up to 12 lakh rupees a year is effectively now tax-free under the new income tax regime. These were also of some prominent highlights of Nirmala Sitharaman's 8th consecutive budget. Let's now go across to my colleague Timsy Jaipuria, who's picking up some details from her sources about what the priority areas were in the budget and how these critical decisions were arrived at. Timsy, over to you.
Well, sources have indicated to us that the big key takeaway of the union budget being the income tax cut, that was primarily done after 6 months of deliberation and not to boost consumption. Rather, the decision was taken to understand the constant demand that the government was getting from the taxpayers, understanding that taxpayers have been giving a healthy share and their demands too demanded a response from the government, and which is why, noting that Prime Minister Modi's government is a responsive government, they wanted to give that sort of a comfort to the taxpayers. On the other hand, a spillover impact of this income tax cut could mean a boost in consumption when it comes to FMCG sales. Also, what sources indicated that government expects the union budget to drive up not just the consumption, but also when it comes to the bank savings, they will also see a significant jump. Expecting that the sales of FMCG companies will also see an uptick by summer, and that is a collateral that the government will get when it comes to the tax cut. Also, the relief is primarily just to note that the taxpayers needed to be rewarded with their demands being heard. On the other hand, when it comes to GST, another crucial area for the government where government is working, sources indicated that the process of simplification of GST rates in terms of rate rationalization is on. The group of ministers is working on it, and now Centre is going to ensure that they take up the issue of merging of the slabs with the group of ministers to ensure that not just certain commodities are moved up and down, but also when it comes to cutting the slabs from 4 to 3, it's something that the Centre will ensure that they work with the group of ministers to get everyone on board on that particular side.
Right, Timsy, do stay with us. Now, outside of the budget, tariffs has been another key talking point over the weekend, especially from all the news action coming out of the US. So, Timsy, tell us, what are you picking up on tariffs, especially the ones coming from the US, and the reduction in duties? We saw quite a few in the budget. Are they aimed towards the US? What are the government's motivations behind these duty cuts that we saw?
Well, yes, sources also indicated when it comes to the developments from the Donald Trump 2.0 administration in terms of tariffs, sources said that whatever has been done by India, especially in terms of custom duty rationalization, tariff reduction, etc., that has been done to understand the demands of the domestic industry, and it has nothing to do with how the Trump administration has been reacting to it. Rather, government says and it feels that there is nothing to be afraid about when it comes to the tariffs and the statements that have been coming from the US when it comes to India. And there's nothing that the government needs to react to as of now. So sources indicated that whenever it comes the way things now take shape, if there's something which needs a reaction, then definitely government will take that reaction. But as of now, nothing needs to be reacted. They are pretty okay when it comes to the statements that are coming from the Trump administration. On the illegal migrants issue also, sources indicated that the Ministry of External Affairs is working on that. They've taken a view that they will do a detailed inspection. They will look into the aspect of these migrants, if they are there without visas, without passports, without any permissions, and if they are Indians, then the country is happy to take them back. But yes, as of now, we'll stick to the view of the MEA. That's what sources indicated. On the other hand, when it comes to the other issues related to the union budget, well, the budget also focused on labor-intensive sectors in manufacturing to regain India's manufacturing footprint in sectors like footwear, textiles, and that is something that was the aim of the government. Also, when it comes to duty cuts on critical minerals and other sectors, the government has been very carefully taking those steps. They are very thoughtful, is what sources indicated, aimed at products that are being made in India. So the domestic interest is what the government has been actually working on, and these decisions are part of that. On the other hand, yes, disinvestments and capex, well, the government is confident of meeting the 11.2 lakh crore rupee outlay for capex for FY26. And on the disinvestment side too, government says that they are hopeful, and whatever on the disinvestment side is left over, it will happen over a period of time when government feels confident about it. But yes, when it comes to targets, government is okay and they are quite comfortable on that side. So that's what sources indicated to us.
Right, Timsy, thanks so much for that. Now, here's the big headline. This was the change coming in for income tax slabs. Now, the annual income of up to 12 lakh rupees has been effectively made tax-free. The new income tax slabs are on your screens right now. The government will forego 1 lakh crore rupees in revenue. This, it hopes, will spur consumption. Now, there's a lot of confusion about the new tax regime, especially around the 12 lakh rupee exemption. Now, many assume that if they earn 13 lakh rupees, then they will be paying tax on only the additional 1 lakh rupees. But that's not the case. Shivani Bajaj is joining us now to help us understand, to explain to us how taxation actually works and how much you actually end up saving under the new tax regime. Shivani.
Well, that's right. Under the new tax regime, now incomes up to 12 lakh rupees are tax-free. But if you earn anything more than that, more than 12 lakh rupees, your entire taxable income is now taxed as per the slab system. Here's how the slabs work. Now, the new slabs say 5% on 4 to 8 lakh rupees, 10% on 8 to 12, 15% on 12 to 16, 20% on 16 to 20, 25% on 20 to 24 lakhs, and 30% beyond that up from 24 lakh rupees. If your taxable income, for example, is 13 lakh rupees, your tax isn't just on 1 lakh rupees. Instead, it's calculated as 5% on 4 to 8 lakh rupees, which is 20,000 rupees, 10% on 8 to 12 lakh rupees, which is 40,000 rupees, 15% on 12 to 13 lakh rupees, which is 15,000 rupees. So the total tax liability comes to 75,000 rupees. Earlier, this was 1 lakh rupees, so you save 25,000 per annum. At 15 lakh rupees, tax is 1.05 lakh, down from 1.40 lakh, saving you 35,000 rupees, and so on. Say, for example, at 25 lakh rupees, the tax is 3.3 lakh rupees, down from 4.4 lakh, saving 1.1 lakh rupees at maximum. So yes, the taxation applies if you earn over 12 lakh rupees per annum, but the new slabs mean significant savings compared to the old system. Back to you.
Right, Shivani, thanks so much for that explainer. Now, the government may be stepping out of the crease on tax cuts, but doesn't want to be stumped out as far as fiscal consolidation goes. It is staying firm on the path of fiscal consolidation. The government is targeting a fiscal deficit of 4.8% this financial year and aims to reduce that figure to 4.4% in the next fiscal.
Coming to 25-26, the total receipts other than borrowings and total expenditure are estimated at 34.96 lakh crore rupees and 50.65 lakh crore rupees respectively. The net tax receipts are estimated at 28.37 lakh crore rupees. The fiscal deficit is estimated to be 4.4% of GDP. To finance the fiscal deficit, the net market borrowings from dated securities are estimated at 11.54 lakh crore. The balance financing is expected to come from small savings and other sources. The gross market borrowings are estimated at 14.82 lakh crore rupees.
Very much in line, right? This is following the rhyme and rhythm of previous budgets. I think conservatism is the needed was the buzzword here. The deficit number is very similar to what we thought. 4.8 goes to 4.4. Nominal GDP assumed quite conservatively at 10.1%, so this year is below 10. And the question was, and we had also said that capex to GDP would remain in line with what is achieved this year, and that's panned out as well. Capex is rising in line with nominal GDP.
The whole exercise, I think, was a balancing act between maintaining fiscal discipline, which the finance minister has put on herself over the last many years, at the same time figuring out a way to bring growth back in. So I think it's been done in multiple different ways. One is the building blocks, is on education, skilling, research, innovation, tech focus. That's very good. Second is picking specific sectors for high growth potential.
Well, India's top industry leaders welcome the tax cuts and the likely boost to consumption. They believe that the demand stimulus was much needed to prepare the pitch for consumption-led story to flourish, and waved a thumbs up to the budget.
Relief to the middle class is very welcome, and it's going to certainly provide impetus to consumption and therefore contributing to the virtuous cycle of investment and employment. And this was much needed at this point of time. Of course, we do expect interest rates also to come off in February to reduce, and that should provide some further impetus. But the larger point of this also would be that this is the immediate relief. But a lot of sectors that have been touched upon in the economy are areas that which are very labor intensive. Right. And the economic activity increasing in those areas will have larger impact on employment generation.
Three key takeaways for us. One is a demand stimulus that was much needed and very well delivered. Second, a focus on making India the manufacturing hub of the world. The focus on ease of doing business, on enabling capital goods to be imported at lower rates, and importantly, addressing the duty inversion that we've seen. These are all things that will help make in India in a much more significant way. And the third is inclusive development, which is also something that is important for us as an economy. So on balance, a very good budget. The capex from a government standpoint stays on course, which is something that we ideally would have liked. And the fiscal discipline stays on course as well.
Well, here's the other key theme, fiscal consolidation. Well, the finance minister has a clear game plan as far as the capex story is concerned. She expects the government to meet 91% of its capital expenditure target by the end of this year. But it's not slowing down on capex. The finance minister has hiked the capex outlay for the next year by about 10,000 crore rupees to a little above 11.2 lakh crores. Now, officials add that the effective capital expenditure outlay rises to 15.5 lakh crores if grants to states are factored in, an indication that states and the private sector have now been asked to do their bit.
The revised estimate of the total receipts other than borrowings is 31.47 lakh crore rupees, of which the net tax receipts are 25.57 lakh crore rupees. The revised estimate of the total expenditure is 47.16 lakh crore rupees, of which the capital expenditure is about 10.18 lakh crore rupees. The revised estimate of the fiscal deficit is 4.8% of the GDP.
There are two kinds of capex. One is the capex per se directly by the central government. The secondly is the capex which goes from the central government first as a grant, as a revenue expenditure, and then it goes into for creation of assets at the hand of the states. So therefore, in the budget at a glance, in the statement itself, you have something called grant in creation of capital assets. Right. And this has been there for many years. And this number is actually 15.48 lakh crores. It's about 15.6 lakh crores. If you really see, there is a 10% growth on the RE numbers over, in this BE for the capex.
Right.
But if you really count the two, it is 17% growth. The capex continues, and our effort will be on implementation of capex.
As far as capex is concerned, again, something what I have been hearing.
A 10% increase.
But if you really see, we were just looking at the budget numbers. It's not only about 11.2 lakh crores which they mentioned. If you take the grants which are given to the states for capital purposes and the capital investment with the public sector, our estimate is the total capex would amount to 19.8 lakh crores.
Well, let's also get some updates from the telecom space. Over the past few weeks, reports have surfaced suggesting that the government is considering a waiver of the bulk of the AGR dues. My colleague Parishit Luthra caught up with the Union Minister for Communications, Jyotiraditya Scindia, on the same subject. Listen in to what he had to say.
The Union government has been mulling a proposal to waive adjusted gross revenue for telecom companies, AGR dues for telecom companies. Could you give us a sense of where is this proposal right now?
I have no idea what you're talking about.
Okay, because there have been reports saying the government is considering a proposal to waive 50% interest and 100% of penalty interest.
I don't know which reports you're talking about. You will hear from me when it happens, if it happens.
So nothing as such under consideration?
I will not comment on that. The Supreme Court has passed a judgment. That judgment stands good.
Okay. Any plan of servicing the MTNL debt of nearly 8,000 crores? There have been reports about a package for MTNL as well.
What is very clear is, as far as MTNL is concerned, is all the operations as of 1/1/2025 have been moved to BSNL. There is going to be a huge amount of monetization of MTNL's assets.
Land
those
assets?
Yes, and those assets will service whatever debt that is there that needs to be serviced.
Well, let's slip into a very short break, but more news and updates on the other side. We'll get you an exclusive conversation with the CBIC chairman, Sanjay Kumar Agarwal, on tariffs and reductions in duties towards the US. Stay tuned.